because stock futures have added about 6 or 7 crore shares in a matter of just 5 or 6 trading sessions. 21 points down for the Nifty spot. We've opened just a point below 5400, which is perfectly acceptable, which means we pretty much have given 50% of what we accumulated yesterday. For the Sensex, it's a cut of about 0.5%, little less than 0.5%. 60 points down now for the Sensex. The Bank Nifty was a volatile instrument on Tuesday. Today the Bank Nifty is off to a soft start. Bear in mind that the Bank Nifty has not really participated in last 10-15 days. So that's really one weak link in an otherwise very strong market. Infosys Technologies. The stock shot up on account of short covering, because after that court verdict, brokerages have not upgraded or changed their price target for Infosys. 24.01 for Infosys, just 8 rupees down. So obviously there is some follow-up buying which you could anticipate for the rest of the day in Infosys. I now want to map financials, because that's one pocket which has not been a performing pocket. State Bank of India 1900 down 13 rupees. ICICI Bank flat start 968 for ICICI Bank. HDFC Bank 596, but HDFC Limited is now marching towards a new all-time high. And foreign brokerages, late last night and this morning, they've upgraded their price target for HDFC Limited. 730 rupees now for HDFC. So in quick time, it has recovered from levels of 660, 670 to about 725, 730. Tire stocks now. They were on tear, and they were on tear across the board on Tuesday. Apollo Tyres off to a good start, 95. JK Tyre, follow-up buying is there. MRF, bear in mind, this is a liquid stock. Things could change for MRF, but CEAT is at 118. So I would say markets have opened flat. They're trading with a downward bias. But the fact that Nifty within minutes of opening has once again regained levels of 5400, that just tells you the underlying momentum.
Rather somber though, you'd have to say, at least going by the headline figures. 0.3% loss coming in for the mid-cap index as well, and flattish for the small caps. Pantaloon, that's the one in focus now that the Competition Commission of India has rejected the notice seeking the nod for Aditya Birla as well as Pantaloon deal. And Pantaloon, after good gains yesterday, has started off in the red today. Just want to see the F&O exclusion list as well. Central Bank, NCC, SCI as well as South Indian Bank. And sure enough, there is some weakness on some of these names today. Walk hard. Remember, pharma as a pack has been in focus, and there is news backing Walk Hard's move today. So the stock is climbing higher by about almost 8 points. They've got the US FDA final okay for a generic drug as well. Royal Orchid, and there should be more weakness on this one as well. You've also got news coming out on Gen Irrigation. The board, remember, is going to meet today to consider the issue of warrants to the promoter group. And after yesterday's losses, Gen Irrigation finally seeing some covering at 74.70, higher by about 1.5%. L&T, they're now looking to sell their equity in infra projects to PE players. So this is a large cap which is in focus. And ONGC is looking to spend about 15,000 crore rupees to drill 480 wells this fiscal. That is what the newspaper reports are indicating. The stock has started off absolutely flat in trade. I just want to see what Kane is up to ahead of his AGM. After Rahul Dhir's exit, all eyes are going to be on the trajectory and the management commentary on what the new management on board entails to do with Ken India and the future plans really going forward. Ken is going strong into its AGM. Work hard as well. They've got their analyst meet today. Remember, the stock has been at a 52-week high, and it's climbing even further at 1273 levels. And of course, Apollo Tyres, as is the case been with the entire tyre basket. So that stock as well starts off well in the green today.
Look at the strength. It's 54.12, 54.13 for the Nifty. So globally things are not looking strong. There are no news triggers, but there is underlying momentum. So the mood is different in that near term. Looking at the way how things are stacked up, and I'm simply looking at the price trend here. On every dip, since dip buyers are making a comeback, the scales are clearly tilted in favor of going long. So if you're a trader there, the rule is very simple. Trend is your friend, and the trend clearly is indicating that markets are headed higher. JX, this question is coming your way. JX, in the short term it is sentiment, in the medium term it is liquidity, and in the long term it is fundamentals. Do you think, given the way how fundamentally things are stacked up for Indian markets, we can justify a level of 5,500 or 5,400 on the Nifty?
Well, I don't think there's a problem justifying that level, simply because for a long time now, we've traded in this range of, let us say, 4,500 to 6,000. and we are bang in the middle of that range, give or take 100 points. And my own sense is that a lot of new components have made life highs, like Hindustan Lever, ITC, and so on and so forth. Big boys like Reliance haven't performed. The HDFC Bank, as you just mentioned, and HDFC, they're close to their lifetime highs. Excuse me. Really speaking, I think we're talking about a different set of components making this thing happen. And I think for a rally to sustain, you need participation. You need a lot more of the mid-caps participating. And I think that is what the next leg between, let's say, September, October, November, and December, during this period will essentially, reveal the kind of mid-cap participation there can be. There's been selective participation. I mean, pharma has been a huge outperformer. There have been mid-cap FMCG stories like, excuse me, like Bajaj Corp, etc., which have done extremely well. They are close to their lifetime highs. Right. So I think the market is pretty selective. There is money coming through. And I, for one, would believe that if you're in, decent stocks, which means 1 in 5 perform the way they are performing, your portfolio should be doing well even as we speak.
Dix, looks like you have a real bad throat. Do you want to sip some water, then I'll come back to you?
No, it's perfectly fine.
It's perfectly fine. Okay, so what are you betting on? Which are the new horses you're betting on?
No, without going specifics, I think we are seeing a decided move on the rupee into a 52-56 range. And we've been betting on the export-oriented sector. If you dovetail this with the fact that people are now betting on the US leading the next bull rally in the world, which means the US, as Ruchir would say, as Ruchir Sharma would say, is a breakout nation, is probably the most likely scenario going forward into the next year and a half. And if the US were to lead the way, then Indian exporters, especially into the US, would be big beneficiaries of this, especially in the context of the labor situation here and the currency situation that they have vis-a-vis, let's say, the Chinese yuan or other emerging market currencies, where the Indian rupee has depreciated virtually across the board. So I think exports is one, engineering goods is another that we are pretty bullish on, and three, locally infrastructure, because I think the FMCG and pharma spaces have already proved to be pretty defensive spaces, and more than that have proved to be spaces which are rich in valuation today. So I think there will be a seamless transition from the defensives and the high PE spaces into the spaces that we just mentioned, and I think those are the areas that we will look at for the rally to sort of pan out into.
So, Jakes, if the Nifty were to move higher to, say, 5,600, 5,700 sort of levels, is that a level where you would be adding positions or booking out?
I think looking at the Nifty to trade specific stocks would be a foolish strategy. I think what we need to understand that the first leg of the rally was fueled by the frontliners and led to a select bunch of frontliners. Now the next leg, while the Nifty may move up 3 to 5%, you could have a whole bunch of mid-cap stocks moving between 20 and 30%. And I think that's the kind of rally that we're looking at in spaces that we like. So the way I would play this is that the Nifty is a sentiment indicator of the way the market mood is an indicator of the liquidity in the world, is an indicator of the ETF money flows coming through, and is an indicator also of the general preference that people have for India vis-a-vis other emerging markets, especially Brazil, China and Russia. Given that kind of preference for India, whether by default or by design, I think the money in stage 2, when the Nifty moves from 5,400 to say 5,800, will be a lot more geared or oriented towards mid-cap stocks. And I think that's the way we would like to play this. So the Nifty at best is a sentiment indicator, and individual stocks is where one's forte should be.
Next, let's start off by chatting about frontliners first. FMCG, and they clearly have performed really well. If you indeed had Unilever and ITC in your portfolio, would you book profits now?
For starters, if I had Unilever and ITC in my portfolio, I wouldn't be, needing to worry too much about where the markets are going, because these stocks are at life highs and they're doing exceptionally well. But given the fact that one has to sort of work hard for a living, and therefore look at individual stories in the mid-cap space, which has been the space that we've looked at, which is the space that we've been always focused on, where it's been a lot more difficult, a lot more selective. I mean, you had the curious case of Infosys getting derated post every result and every announcement, and TCS getting re-rated exactly for the same reasons after every announcement or every result. So I think it is so stock specific a rally, and even within spaces it's so stock specific that one has to be really oriented towards where the markets have seen risk, they have shunned away, where the markets have seen leverage, they moved away, whereas those could be the opportunities if the rally were to sustain. That some of these highly leveraged companies or the companies that have essentially been beset by capex, etc., once they sort of come out of that mode, may find favor with the markets a lot more than they're finding favor today.
So will the rally sustain in a Unilever and an ITC?
My own sense is no. Right now these are, to me, the lever and the ITC trade is similar to, let's say, the gold trade at 1800, where the world rushed into gold saying that we can't under any scenario see a slowdown in the buying of gold. We can't see a slowdown in the demand pull for gold. And I think that kind of consensus move herded people into gold at that time and possibly into levers and ITC right now. So I think there will be a move out from these spaces. They're very, very richly valued. And I think if the economy overall were to slow down to 5.5%, 6.5% range, you will have consumption slowdown clearly, and consumption slowdown that hits the rural spaces as well, which has been the bulwark of every rise in demand from an HLL or ITC perspective. So I think the way I would play this is that I'm definitely seeing Q3, Q4 being slower for these spaces, and the valuations have run up. Right now they seem to be at the receiving end of ETF money, and therefore because ETF money comes into buy index stocks, the people have been under-owned in this, and therefore even for small amounts of index-based buying, the levers in the ITC move up disproportionately compared to an index move.
So within the consumption space, Jackson, when I say consumption, autos, FMCG, consumer durables, where to your mind there is a boom and there is a bust?
I don't think there's a bust as such in the consumption space. I think the one area that certainly is under a lot of pressure, consumer linked, is telecom, where all kinds of regulatory changes are making it impossible for these guys to make money. All that happens on a daily basis. There are more deals being given out as far as the individual users of cell phones, etc. are concerned. So telecom is definitely a space we are decidedly negative on. But apart from that, all of the space have been meeting with reasonably good demand and ground-up demand at that. Not city-based, not metro-based, but rural demand. But if you eliminate that, I don't think there is a boom-bust scenario here. I think there's a slowdown in growth, and there is a decided, recessionary trend as far as pricing power is concerned in telecom. Other than that, I think, the consumption space is just fine, except that the P's in many cases don't justify or warrant the kind of underlying consumption there is, which I think would come in for severe, should come under severe pressure. Especially if you take, let's say, the retail space, where same-store growth has been, decidedly poor for a number of players, especially people like Pantaloon, etc. Then you will realize that consumption is slowing down, and that therefore cannot keep these valuations at these lofty levels.
Next, you mentioned infrastructure as well earlier. What is it that you like out of that space?
I'm just waiting, for government to go ahead and start announcing the basic minimum number of, kilometers of road per day kind of thing. A few visible infra projects being awarded, maybe something in the power space. And there will be some action because most of these are priced close to bankruptcy levels today. They're all quoting way below book. They're quoting well below replacement cost. They're definitely quoting close to bankruptcy levels, where the ratio, which is debt to market cap, becomes more relevant, because at market cap, which is well below net worth, people are not able to raise money, and therefore debt to market cap becomes a reality because you're close to, as I said, bankruptcy pricing. I think if a few announcements, a few orders came good, then some of these stocks could give you outsized returns in a market where clearly nobody is finding favor with these stocks.
Jix, over the years I've known you, you've always identified concept stocks. That's your specialty. So which are the new concept stocks you're betting on, with a disclosure and with a caveat that these are high risk, high return ideas?
I think media is one space that I would consider in that category, where I would consider media as a play where, with greater disclosure, greater, with this entire digitization, etc. And the number of, should I say 100 crore plus or 150 crore plus movies that we're having, the latest being Ekta Tiger. I think you're talking about some serious money coming into this space, both locally and from overseas. And if that were to happen, the existing players will find strategic interest forthcoming in terms of equity holdings, etc. So I think there's going to be a, if not already happening, a gradual unification of the Indian entertainment space with the rest of the world. And with that will come the, excuse me, the pricing power